Hey everyone, welcome to Finance First TV. In today's video, we're kicking things off with the ultimate beginner's guide to personal finance. If you've ever felt overwhelmed by money management or unsure where to start on your financial journey, you're in the right place. Stick around as we cover everything you need to know to take control of your finances and build a solid foundation for wealth creation. Before we dive into the content, we want to take a moment to thank you all for being here. We know there are a lot of finance channels out there, so we appreciate you taking the time to be here with us. If you're new to the channel, be sure to hit that subscribe button and turn on notifications for more finance content like this. It's free and you'll never miss an episode. Today, we're starting at the beginning with a comprehensive overview of personal finance essentials. From setting financial goals to creating a budget and understanding the power of compounding, we'll cover the key concepts that form the cornerstone of financial success. Setting financial goals is crucial for guiding your financial decisions and staying motivated on your journey toward financial freedom. When setting goals, it's essential to follow the SMART criteria. Specific goals should be clear and well-defined. Instead of saying, I want to save money, a specific goal would be, I want to save $5,000 for a down payment on a home. Measurable. Goals should be quantifiable so that progress can be tracked. For example, I want to pay off $10,000 of credit card debt within the next 12 months. Achievable. Goals should be realistic and attainable given your current financial situation and resources. Setting goals that are too ambitious may lead to frustration and discouragement. An achievable goal might be, I want to increase my monthly savings contributions by 10%. Relevant. Goals should align with your values, priorities, and long-term objectives. Make sure your goals are meaningful to you and contribute to your overall financial well-being. A relevant goal could be, I want to establish an emergency fund to cover 6 months' worth of living expenses. Time-bound. Goals should have a specific deadline or time frame for completion. This helps create a sense of urgency and accountability. For instance, I want to save $10,000 for retirement by age 30. Short-term goals. These are objectives you want to accomplish within the next year or less. Examples include building an emergency fund, paying off a credit card balance, or saving for a vacation. Medium-term goals. These are objectives you want to achieve within the next 1 to 5 years. Examples include saving for a down payment on a home, funding a child's education, or purchasing a new vehicle. Long-term goals. These are objectives you want to accomplish in 5 years or more. Examples include saving for retirement, buying a second home, or achieving financial independence. By following the SMART criteria and categorizing your goals into short-term, medium-term, and long-term objectives, you can create a roadmap for your financial future and stay focused on what's most important to you. Budgeting is the process of creating a plan for your money, ensuring that you're spending less than you earn and allocating funds toward your financial goals. Here are some practical tips for reducing expenses and optimizing your budget. Track your spending. Start by keeping track of all your expenses for a month. This will give you a clear picture of where your money is going and highlight areas where you can cut back. Identify non-essential expenses. Review your expenses and identify non-essential items that you can live without or reduce. This may include dining out, subscription services, impulse purchases, and entertainment expenses. Set spending limits. Once you've identified non-essential expenses, set spending limits for each category based on your financial goals and priorities. Use cash envelopes or budgeting apps to help you stay within your limits. Shop for discounts. Look for ways to save money on everyday purchases by shopping for discounts, using coupons, and taking advantage of sales and promotions. Consider buying generic brands, shopping at discount stores, and comparing prices before making a purchase. Reduce utility bills. Lower your utility bills by conserving energy and water in your home. Turn off lights and appliances when not in use. Use programmable thermostats to regulate heating and cooling, and repair any leaks or drafts to improve energy efficiency. Meal planning. Plan your meals in advance and create a grocery list based on your meal plan to avoid impulse purchases and reduce food waste. Cook at home more often and pack lunches instead of eating out to save money on dining expenses. Limit discretionary spending. Be mindful of discretionary spending on items like clothing, gadgets, and entertainment. Consider implementing a cooling-off period before making non-essential purchases to avoid impulse buying. Review and adjust your budget. Periodically review your budget and track your progress toward your financial goals. Adjust your budget as needed to accommodate changes in income, expenses, or financial priorities. Seek out free or low-cost activities. Look for free or low-cost activities for entertainment and recreation, such as visiting parks, attending community events, or participating in hobbies that don't require significant financial investment. By implementing these practical tips, you can reduce expenses, optimize your budget, and make progress toward your financial goals. Saving involves setting aside a portion of your income for future use, while investing involves putting your money to work in vehicles that have the potential to grow your wealth over time. Let's explore some common savings vehicles and investment options, along with their benefits and risks. Savings accounts. A savings account is a low-risk, interest-bearing deposit account offered by banks and credit unions. It's an excellent option for short-term savings goals and emergency funds. Benefits include easy access to funds, FDIC or NCUA insurance, up to specified limits, and stability of principal. However, savings accounts typically offer lower interest rates compared to other investment options, which may not keep pace with inflation over the long term. Certificates of deposit, CDs. CDs are time deposits offered by banks and credit unions with fixed terms and interest rates. They offer higher interest rates than savings accounts, but require you to lock in your funds for a specific period, ranging from a few months to several years. Benefits include guaranteed returns and FDIC or NCUA insurance, up to specified limits. But CDs may have early withdrawal penalties if you access your funds before the maturity date. Money market accounts, MMAs. MMAs are interest-bearing accounts that typically offer higher interest rates than regular savings accounts. They may require higher minimum balances and limit the number of withdrawals or transfers allowed per month. MMAs provide liquidity and stability, making them suitable for short-term savings goals or as a cash management tool within an investment portfolio. Stocks. Stocks represent ownership shares in publicly traded companies. Investing in stocks offers the potential for long-term capital appreciation and dividend income. Stocks historically have provided higher returns than other asset classes over the long term, but also come with higher volatility and risk of loss. It's essential to research and diversify your stock investments to mitigate risk. Bonds. Bonds are debt securities issued by governments, municipalities, or corporations to raise capital. Investing in bonds provides a fixed income stream through periodic interest payments and the return of principal at maturity. Bonds are generally less volatile than stocks and offer diversification benefits within an investment portfolio. However, they may be subject to interest rate risk, credit risk, and inflation risk. Mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They offer professional management, diversification, and liquidity, making them suitable for investors seeking broad exposure to the financial markets. Mutual funds charge fees and expenses, which can impact returns over time. Exchange-traded funds, ETFs. ETFs are similar to mutual funds but trade on stock exchanges like individual stocks. They offer intraday trading flexibility, lower expense ratios, and tax efficiency compared to mutual funds. ETFs provide diversification across asset classes, sectors, or regions and can be used to implement various investment strategies. Real estate. Real estate investments include direct ownership of rental properties, real estate investment trusts, REITs, and real estate crowdfunding platforms. Real estate offers the potential for rental income, capital appreciation, and portfolio diversification. However, it requires significant capital, ongoing maintenance, and may be illiquid compared to other investment options. Retirement accounts. Retirement accounts such as 401ks, IRAs, and Roth IRAs offer tax advantages for long-term savings and investing. They allow you to contribute pre-tax or after-tax dollars and grow your investments tax-deferred or tax-free until retirement. Retirement accounts provide a disciplined way to save for retirement and may offer employer matching contributions in the case of employer-sponsored plans like 401ks. Asset allocation involves spreading your investment portfolio across different asset classes, such as stocks, bonds, cash, and real estate, to manage risk and achieve your financial goals. Diversification involves spreading your investments within each asset class to further reduce risk. By diversifying your investment portfolio, you can reduce the impact of individual security or asset class risk on your overall portfolio. Different asset classes tend to perform differently under various market conditions, so a diversified portfolio can help smooth out investment returns over time. Asset allocation and diversification help balance risk and return based on your investment objectives, time horizon, and risk tolerance. It's essential to periodically review and rebalance your investment portfolio to ensure it remains aligned with your goals and risk preferences. By understanding the various savings vehicles and investment options available, as well as the principles of asset allocation and diversification, you can build a well-rounded investment portfolio tailored to your financial goals and risk tolerance. Debt can be a significant obstacle to financial freedom. But with a well-structured repayment plan and disciplined approach, you can regain control of your finances. Here are detailed steps for creating a debt repayment plan and managing debt effectively. Assess your debts. Start by making a list of all your debts, including credit cards, student loans, auto loans, personal loans, and any other outstanding balances. Note the outstanding balances, interest rates, minimum monthly payments, and due dates for each debt. Prioritize your debts. Once you have a complete list of your debts, prioritize them based on factors such as interest rates, balances, and terms. Consider using the debt snowball or debt avalanche method to prioritize debts for repayment. With the debt snowball method, you focus on paying off the smallest debt first while making minimum payments on all other debts. With the debt avalanche method, you prioritize debts with the highest interest rates first to save money on interest charges over time. Create a budget. Develop a realistic budget that allocates a portion of your income toward debt repayment while covering essential expenses such as housing, utilities, groceries, and transportation. Cut discretionary expenses and redirect those funds toward debt repayment to accelerate your progress. Negotiate with creditors. If you're struggling to make payments on your debts, don't hesitate to reach out to your creditors to discuss alternative repayment options. You may be able to negotiate lower interest rates, reduced monthly payments, or extended repayment terms. Be honest about your financial situation and explore hardship programs or debt consolidation options that may be available. Stay motivated. Paying off debt requires patience and perseverance, so it's essential to stay motivated throughout the process. Set small, achievable goals and celebrate milestones along the way. Visualize the benefits of becoming debt-free, such as financial freedom, reduced stress, and increased flexibility. Surround yourself with a supportive network of family and friends who can encourage and motivate you on your debt repayment journey. Avoid new debt. While you're focused on paying off existing debt, avoid taking on new debt whenever possible. Cut up credit cards or put them on ice to prevent impulse spending. Practice delayed gratification and prioritize your financial goals over short-term wants. Focus on living within your means and building healthy financial habits that will serve you well in the long run. Make timely payments. Making timely payments on your debts is crucial for maintaining a positive credit history and improving your credit score. Set up automatic payments or reminders to ensure you never miss a due date. Consider setting up a debt repayment schedule that aligns with your paydays to make budgeting and bill payments more manageable. Monitor your progress. Regularly review your debt repayment plan and track your progress toward becoming debt-free. Celebrate your achievements and adjust your plan as needed to stay on course. Use tools like debt payoff calculators or financial apps to visualize your progress and stay motivated. Focus on long-term financial goals. As you work toward paying off debt, keep your long-term financial goals in mind, such as saving for emergencies, investing for retirement, or achieving financial independence. Use your debt repayment journey as an opportunity to develop good financial habits and set yourself up for future success. By following these detailed steps and staying committed to your debt repayment plan, you can overcome debt and pave the way for a brighter financial future. Thank you for joining us on this journey toward financial empowerment. By mastering the basics of personal finance, you can take control of your financial future and build a life of abundance and security. Remember to set clear financial goals, create a budget, save and invest wisely, and manage your debt effectively. If you found this video helpful, please consider subscribing to Finance First TV for more valuable finance tips and insights. Thanks for watching Finance First TV. Don't forget to subscribe for more finance insights. See you in the next video.